these reforms have been carried out with a focus on the common man. Every tax levied on common man's daily use items have gone through a rigorous looking into, and in most cases the rates have come down drastically. Labor-intensive industries have been given a good support. Farmers and agriculture as a whole will also benefit by the decisions we have taken today. Health-related also will benefit. So the key drivers of economy have been given a prominence. And much before I get into the details, I want to thank every member of the GST Council, every finance minister who attended the GST Council today. There was no absence. Everyone was present. We've had a day-long intense discussion, but I'm grateful to each one of them. At the end of the day, they said, we're all together for the sake of the common man. एक भी रिजर्वेशन के साथ नहीं समर्थन किए, मगर पूर्ण मन से भरपूर सपोर्ट दिए हर राज्य के वित्त मंत्री। इसीलिए मैं जीएसटी काउंसिल को आभार कहना चाह रही हूं कि लंबा चौड़ा डिस्कशन चला आज, मगर आखिर हर मेंबर इसके लिए समर्थन दिए, इसीलिए मैं धन्यवाद कहना चाह रही हूं। Common man and middle class items में there is a complete reduction. Reduction from 18 or from 12 to 5%. I list out those items, all of whom have come to 5% from either 18 or from 12. Common man items such as hair oil, toilet soap, soap bars, shampoos, toothbrushes, toothpaste, bicycles, tableware, kitchenware and other household articles have all come to 5, whether they were in 18 or whether they were in 12. Similarly, reduction of GST from 5% to nil, 5 से 0 में जाने वाले items indicate कर रहा हूं. Ultra high temperature milk, the UHT milk, chena or paneer, all the Indian breads will see nil rate. So roti kisi ke upar bhi, chapati or roti or paratha or whatever it is, they all come to nil. Reduction of GST from 12% or from 18% to 5, इसमें फूड आइटम्स बहुत सारे हैं, नमकीन से भुजिया है, सॉसेस है, पास्ता है, इंस्टेंट नूडल्स है, चॉकलेट्स, कॉफी, प्रिजर्व्ड मीट, कॉर्नफ्लेक्स, बटर, घी, ये सब 5% में आ रही है. GST from 12% और from 18% to 5, इसमें फूड आइटम्स बहुत सारे हैं, नमकीन से भुजिया है, सॉसेस है, पास्ता है, इंस्टेंट नूडल्स है, चॉकलेट्स, कॉफी, प्रिजर्व्ड मीट, कॉर्नफ्लेक्स, बटर, घी, ये सब 5% में आ रही. फिर there is one special rate which is only for sin and super luxury goods. That special rate of 40% has also been proposed and it's cleared. That will apply only to pan masala, cigarettes, gutka, and other tobacco products such as chewing tobacco, products like zarda, unmanufactured tobacco and weed. इसमें मिडिल क्लास के एस्पिरेशंस मीट करने वाले बहुत सारी चीज हैं. एयर कंडीशनिंग machines, TVs which are over 32 inches, all TVs now at 18%. I want to underline, all TVs are now at 18%. Dishwashing machines, small cars, motorcycles equal to or less than 350 cc are all now coming to 18.
GST rate cuts are just around the corner, making everyday spends from groceries to medicines cheaper. As per Finance Minister Nirmala Sitharaman, the rejig is expected to put nearly 2 lakh crore rupees back into the hands of the consumers. But what does that mean for you as a family of 4 or as an individual consumer? Let's find out. But it's important to note that these are just ET Now estimates based on a survey internally conducted by us. To help you understand what the setup of this survey is, we've imagined 3 families across different income groups per month. Family A earns 28,000 rupees a month. Family B earns a monthly income of 1.5 lakh rupees, and you have family C at the end that's earning a monthly income of 5 lakh rupees. We'll track their spends and see what they are going to save after the September 22nd rate cuts are implemented. Now, to give you a picture on the math that we've used, here's the math to begin with. Grocery bills, let's talk about that. They now work out about 4% cheaper based on a Kotak estimate for GST cut across categories that fall in this basket. Dining out, let's talk about that. That has gone from 12% to 5%, which is a 7% saving. Entertainment such as movie tickets is unchanged at 18%, so no benefits there. Telecom too, no benefits over there as well on your telecom or your mobile phone bill. Medicines have become cheaper by 7%, falling from 12% to 5%. So that's the 7% savings on medicines that you can see over there. For personal care, items such as soaps and shampoos are down by about 10%, once again based on the Kotak estimate across categories in this basket. And well, yes, the biggest relief is coming in on the life and health insurance premiums, because they have been completely exempt from GST, which means they were charged at 18% earlier, 0% GST now, which means the total saving for your insurance bill is straight up 18%. Let's begin with the families and take a look at their individual savings. For family A, let's start with the category of grocery, and family A spends 4,000 rupees a month and now saves 160 rupees a month when it comes to grocery. So there you have it, 4,000 rupee in spend, 160 rupees in saving. That is the case coming in for family A. Family B now, it saves 640 rupees after a spend of 16,000 crore rupees a month on grocery, and family C spends 45,000 crore rupees and saves 1,800 in terms of groceries. So the final saving here is 4%, and those are the individual amounts that all the 3 families are saving, accumulating up to 4% of their total bill. Next up, let's take a look at dining out. Family A spends 2,000 and saves 140 rupees per month. Family B is spending 4,500 and saves 315. And lastly, family C spends 10,000 rupees a month and saves 700, making the overall savings 7% for all these 3 families. So there you can see it over there. Now let's move on to entertainment and talk about what's happening over there. No change at all. Similar for telecom. So no change when it comes to both of these categories. Coming to medicines now, family A has no spend on medicines as of now. We'll take a look at what family B is doing. They're spending 4,000 and saving 280. Family C spending 5,000 rupees and saving spending 5,000 and saving a final amount of 350 rupees, which brings the final cumulative amount for all these 3 families to a 7% saving. Moving on to the personal care category, family A is spending 500 and saving 50. For family B, it's a spend of 2,500 and saving 250 rupees. Family C spends 5,000 and saves 500 rupees. And remember, the final GST rate cut over here is 10%, so that's the overall saving coming in. Now let's talk about the big category, the biggest beneficiary coming in out of the entire GST ambit, and that is insurance. First up, on health insurance, when we poll these 3 families, family A spends 1,250 rupees and saves 225 rupees. You have family B that's spending 3,000 rupees and saving 540. Family C spends 6,500 and saves 1,170, which after doing the math, remember 18% complete exemption, so 18% is the saving, and these are the individual amounts that all these 3 families are saving for health insurance premiums. And lastly, similarly for life insurance, family A as of now has no spend, but if you take a look at family B, they spend 8,000 and save 1,440. Family C spends 25,000 per month on life insurance premium and save 4,500. So the final saving here, just as was the case with health insurance, is 18%. So across families A, B and C, monthly savings, let's take a look at what the overall monthly savings picture is. That's the percentage saved, anywhere between 6.5 to 7.8. So 6.5 to 8% of monthly savings overall, a meaningful cushion for household budgets. Now that money can easily flow into higher discretionary spending or investments like SIPs and equities. In short, the GST cut just got friendlier for you and your pocket.
Big GST relief is here from September 22nd, 2025. GST on individual health and life insurance premium has been reduced from 18% to 0. Let's quickly break down the top questions you might have. So frequently asked question is, though GST relief is on new premiums or renewal? Yes, GST exemption applies to both new and renewal policies as long as your premium is due on or after September 22nd. Second frequently asked question, already paid premium before 22nd September? If you have paid your premium before September 22nd including GST, sorry, no refund. The benefit starts only after the date. Third frequently asked question, grace period renewals. If I renew my policy in a grace period, premium paid during the grace period before 22nd September won't qualify. Only those due on or after the GST free, that is after 22nd September. Fourth frequently asked question, which policies are covered for the GST exemption? So almost all individual policy, which includes your health plan, term plan, unit plan, the endowment policy, ULIP policy, family floater, senior citizen plan, even top up and riders are exempted from GST premium. Fifth frequently asked question is, premium will come down immediately? Absolutely. The GST component is removed, so your base premium stays, but the amount you pay is lower by 18%. So another sixth frequently asked question is, what about the group insurance? So answer is no GST relief on your group policies like employer health cover. The benefit is only for individual policy, retail policy as announced by government. Seventh frequently asked questions, what about monthly EMI premium? So no matter what the payment mode, monthly, quarterly or annual, GST is waived if the due date is September 22nd or later. Eighth frequently asked question is, will premium still rise going ahead? Maybe. Base premium can still rise due to medical inflation, but 18% GST is permanently gone. Another important question is, what happens to auto debit and ECS? So no action needed. Your insurer will auto adjust and deduct the updated amount without GST. So that's your quick guide to GST free insurance. Less tax, more saving.
Let me welcome Sandhya, who is the Group Chief Financial Officer at Narayana Health, joining us on the show right now. Hi Sandhya, morning and good to be speaking with you. And firstly, let's talk about your India business. Help us understand how is the quarter shaping up for you in terms of the occupancy growth, and along with that, Sandhya, is the big GST rate announcement that has been made. Do you believe it can benefit the hospital sector in any way? Because there were cuts that were announced on medicine, medical devices and as well.
Good morning.
Good morning.
Thank you for having me here. So the hospital business, as you are aware, is cyclical. So Q1 and Q3 tends to be a little muted, and Q2 and Q4 tends to be slightly more robust. Beyond that, since the quarter is still underway, I would not be able to share more information. Most of our growth continues to be organic. No new capacity has gone live. Therefore, our growth will be in line with the organic growth that you can expect from the industry. GST is a very welcome change. For us, if you look at it, one aspect is the medicines. It's fallen from 12% to 5%. We buy about 500 to 600, 700 crores of or we sell about 600 to 700 crores of medicines in that category, and all of them will benefit from the GST reduction. In addition to that, there will be some savings that we will see in the capex cycle, as well as some savings in the medical equipment. According to us, the most important thing for healthcare is to be affordable and accessible. And any measure that enables bring the price of healthcare down to the end consumer is very, very welcome. So I am very sure that this will make healthcare a little bit more affordable for our patients.
Welcome to our Expert Speak segment on Insurance Mantra. Joining us today is Parthnil Ghosh, Executive Director, HDFC Ergo General Insurance. It's a pleasure to have you with us on the show today, sir. Thank you so much. I just want to begin with on the latest development in insurance industry, that GST reduction. So according to you, how big is this development and how this will help in increasing insurance penetration?
First of all, thank you, Anurag, and good morning. Uh, as far as the GST, this latest GST reduction is concerned, first of all, I would like to thank the government and GST Council for ushering in this extremely welcome move for at least for the insurance sector. Now, health insurance premium, we have been always demanding that the GST reduction should be there. Now, an 18% GST will come down to nil. It means that for general citizens, for common citizens, Indians, the reduction of the premium will be to the extent of 18%. What does it mean? If the premium would have been 100 rupees previously or till date, the GST is charged 18 rupees. It would have been 118 rupees. From 22nd of September, it will become 100. So at one stroke, the affordability index of the Indian citizens on health insurance premium is going to go up by a few notches.
The GST removal of GST on the insurance, individual insurance products is a very big announcement by the government. And the government has been engaged with insurance companies, both private and public. And DFS held a meeting 2 days ago with the insurance companies on their proposed action in view of the GST reduction. And all of them, including the private sector, have assured they'll be passing on the benefit to the policyholders. Most of them have come out with advertisement, clarifications to the public, and we hope that policyholders or future people who want to buy insurance products, they will be encouraged with the reduction in the policy premiums and buy more insurance products.
And so it's a very big game changer move to achieve the insurance for all target, which is government's move, DFS mission and vision, and the insurance penetration will increase after this move.
We definitely think so. We need to have broader coverage of entire population with insurance. This move will benefit lakhs and lakhs of people who want to buy insurance. This will encourage, and along with this, we are also taking a campaign to educate and create awareness for the various benefits of insurance products to the population. And I think this is already successful. This quarter, we have seen growth in the premium and new policies also.
Okay, so my last question, so Bima Sugam official website is launched. How big development is this? Because Bima Sugam will completely democratize the insurance in India.
We would like to have this by end of this year, fully integrated portal where everybody will be on it, and that could be one of the game changers in the insurance industry in the country.
So to begin with, sir, I will start with the GST reduction announcement only. So there are other PSU companies, they have announced that they will be passing on the complete benefit and without change in commission structure. So are you also doing the same?
Yes, we shall pass on the complete benefit of GST reduction to our customers, and we have already publicized it through our our website and social media, as well as from through our network of offices across country and through our intermediaries. If we explain it in simple terms, if the premium for a health retail product was 100 rupees, and with the service tax of 18%, if the customer was paying 118 rupees to the insurance company before 22nd September. So from that date, from the revision date or from the reduction date, the customer will be paying only 100 rupees. And this entire benefit shall be passed on to the customer, and we shall not be revising the premium rates, or we do not intend to revise or reduce the agent commission also.
Okay, sir. So you are saying that agent commission also will not be revised, and complete benefit also will be given to policy holders. So that means that you will be taking hit on your P&L, and what will be the quantum of hit?
It is true that there will be an impact on our balance sheet. It may be in the range of, say, I cannot tell you very accurately, but it is expected to be in range of 80 to 100 crores. However, we have as you see, out of our more than 20,000 crore premium, 8,200 crore is coming from health portfolio, health LOB. But out of this health LOB also, the large part comes from the group health segment. And our retail health segment actually constitutes less than 10% of our overall portfolio. Hence, I think that with our other than retail health portfolio and the growth which we are experiencing, we will be able to absorb this impact in our balance sheet, and we will not be needed to revise the premium or reduce the commissions. So I think we will manage.
FMCG, both of those sectors are going to be benefited with the GST rationalization, and another sector would be the auto. And now what we are hearing is that Maruti Suzuki has reduced the automobile prices based on models due to GST revision. Nivedna Prabhu joins with more details on that.
Well, ever since the GST rate rationalization was announced, every sector, of course, has welcomed that particular move, and the auto sector is no different. But talking about Maruti Suzuki India, have gone ahead and put things into perspective for, of course, not just pricing, but the rationale behind it. The management says it is to ensure that affordability remains the peg. And look at the small car segment, whether you're talking about the Espresso, the Alto K10, the Celerio, the Wagoner, and Ignis as well, some fabulous discounts that have been given from the management side. This is because they want to ensure that not just the fact that the consumers can avail these discounts, but also if they had a budget in mind, that can be also changed, because Wagoners, at least you're looking at a 79,600 rate card. If you're talking about premium hatchbacks, the Swift is looking at a 84,600 rate card, a Baleno about 86,100. The sedan as well is no different. The Desire is also looking at a very interesting price cut of 87,700. Compact SUVs also, whether you're talking about Fronx, Brezza, they're all looking at very interesting numbers. In fact, about 1 lakh, if you actually look at those numbers playing out on your screens as well. Grand Vitara is no different. It's up to 1,07,000. Multi-purpose vehicles are also not far behind, because you talk about the Ertiga, the management's decided to go with up to 46,400. The Invicto is also looking at up to 61,700. And commercial vehicle, that is the Super Carry, is getting a discount of 52,100. So all in all categories, this is essentially what Maruti Suzuki India has decided to go ahead with. Of course, in tandem with what we're already looking at in terms of the GST rate rationalization, but they're also hoping for the fact that this is going to change the way the consumers also engage, and of course, in turn, that really creates momentum for the auto sector.
After autos were actually very positive on consumption. We think this GST the cut is coming as a big boost to affordability. Also, the timing is very opportune just around the festive season. And then this is also happening after almost an year and a half of fairly subdued demand.
True.
So this, in our view, should bring a very big boost to demand. When I think of different segments of demand, let's say entry versus mid and maybe premium across two-wheelers and passenger vehicles, while yes, affordability improvement helps the entry level a lot. But we also believe that people who were maybe earlier going to buy an entry-level vehicle will now have the capacity to buy maybe a mid-sized car or a motorcycle. So I think that the demand boost that comes is going to be across the different segments. And that can be very specific, like a 350cc plus motorcycle, which is specifically seeing a GST increase. But other than some very specific segments. We think this is a very broad-based demand boost and not just at the entry level.
You're looking at from an up-trading perspective, right? In the sense, if the kind of boost that a person gets is from 70 to 90,000 rupees per car, and that could give him additional leeway to look maybe a model higher or a upgrade higher to a higher level. Is that what you're looking at, and it's not going to change the entry level dynamics?
No, so what I meant was there is going to be a demand boost across the categories.
Yeah.
So at an entry level, so for someone who was finding it difficult to afford a vehicle earlier, right, it becomes a lot more easier for him to afford. So we're not saying entry level will not get a boost. Entry level should definitely get a boost, but that demand boost is not limited to the entry level, because someone who was earlier going to buy, let's say, an entry level vehicle, now will have the capability to buy something better. So the demand, the entire curve of demand gets lifted upwards rather than just in one single category.
From an earnings point of view, how do you see that panning out for FY26 and 27? You almost have 2 quarters, which is almost like a slow, sluggish growth coming in, a boost coming through consumption, maybe Q3, Q4 onwards, which will be there. You see FY27 to be the big year in terms of numbers, volumes?
Yeah, so we do think second half FY26 and that flowing into FY27 through FY28 should be very strong for volume growth and earning growth for most of the companies. So across most of the OEMs, we are thinking anywhere between 10 to 15, 16% 3-year volume CAGR, and that translating into, let's say, a 12, 13 to a 25% kind of an earnings CAGR over the next 2 to 3 years.
Yes, and Tarun, thank you so much for your time and good speaking with you. And let's talk about the real excitement in place. GST cuts, they are live now. You too have announced the price cuts. Help us understand the demand sentiment right now and how big this festive season could be. What sort of a incremental volume growth are you expecting?
Thank you, Srishti, for having me here. And at the outset, I'd like to really thank the Honorable Prime Minister for ushering in these huge GST reforms. I believe they will give a big impetus to the Indian economy, and especially talking about car industry. If you see last 20 years, never before this kind of a GST cut has happened. I've seen 4%, 6% cuts happening, but now 10%. In fact, 10 to 13% for small cars, and even in the big cars, 3 to 10%. So it's a huge cut. You talked about the growth expectations. It is always very difficult to predict. But if you see last few months, April to August were kind of very muted for the domestic market. Industry has been at -2%, but the CAGR, if you see the 5 years, has been at about 4.5 to 5%. So I believe with this impetus provided by the GST cut, we'll be back to the 5% thing. So the swing, if you see, from -2 to 5 will be about 7%. So like I said, these are only my initial estimates. The bookings have really gone up. Last few days, we were the first company to announce full passing of the GST cut benefit to the customers. So the showroom traffic has increased. Of course, the 22nd September will usher in the Navratra season, which is very, very auspicious and very good for most of the country, and then followed by Dhanteras and Diwali as well, and then the marriage season kicks in. So I think we are really expecting some very good demand coming in from 22nd September onwards.
Well, indeed, everybody is excited to for that to happen. And from
we are seeing the GST benefits being reduced from 28 to 18%. As we speak, the guidelines, based on the guidelines, our teams are working out the details. Right. But of course, we will be honoring in full spirit, as well as making sure the consumers have a very, very fantastic, great festive season.
Right. Great timing as well. The festive season, of course, like you just mentioned, is well and truly upon us. What's the outlook like as far as sales are concerned? Massive impetus by way of the GST rationalization announcement. Many goods have now seen a downward movement in terms of the GST slab. Gaurav, what are you expecting from the great Indian festive season this year in terms of sales?
Well, we were already looking forward to a great festival season. If I were to talk before what we just heard a few days ago from the GST Council as well as from the Finance Minister, we were seeing, and we have seen, a great monsoon this year, 104% plus over the long-term average. We've seen great level of waters in the reservoirs. The macroeconomic fundamentals remain strong in the country. The repo rates have been encouraging. On top of that, what we are seeing now is this bonanza. So, you know, it is going to become good to great, and we're looking forward to probably the best Diwali ever and building it up from there.
Let's now welcome on board someone who must be all smiles, Rajesh Ajirkar, ED and CEO, Auto and Farm Sector at M&M, joining in on the show right now. Rajesh, hi, morning. How is it that you're seeing this GST bazooka? EV rate remains unchanged at 5%. Big push to demand, you think?
Yeah, Aisha, pleasure to be on the show. And like you said, yeah, it's all good news everywhere. We see every part of our portfolio gaining. EV, of course, stays at 5%, which is good news. It reinforces the government's commitment to EV being the destination technology for the country. So we're glad that that's not been changed. But every other part of our portfolio has seen a reduction. Tractors is a big part of our portfolio, so that moves from 12 to 5. And then, of course, CVs has seen a very big increase. 10% is a very good reduction in the commercial vehicle segment. And then every part of our SUV portfolio also gains between 8 and 13%. So overall, very positive news, and we're delighted, and we think it'll be a big driver of growth for the economy and the business.
Oh, well, indeed, Rajesh, great news coming in. But Rajesh, 22nd September onwards, where the new rates will be applicable from. But for now, some questions remains to be on what will happen to the cess. If you can help us understand, what about the compensation cess that is already in the books? How do you see the clarity emerging on how that will be adjusted for the OEMs, for the dealers as well?
Yeah, Shrishti, that's, you know, in any transformation, there are going to be some transition issues, and this is one which is related to compensation cess, which still needs some clarification. We will be working through the industry body SIAM to take this up with the government and get clarity over the next few days. But these are transition issues, and I'm sure we'll work around that. The overall picture is going to be a very positive demand boost. And while we work on the transition issues, you know, we have to see the big picture, which is very positive.
For your prime customers, and this of course comes in at a time when the government has also introduced the bumper GST rate rationalization bazooka, both in terms of slabs and of course you know, the rate cuts that we've seen. You know, if you could give us a sense of how you know, your sale days are going to pan out, especially as far as your expectations are concerned in tier 2 and 3 towns and cities versus you know, the urban metros, the kind of categories that will particularly see a boost as a result of this policy move.
Yeah, I think like even before that, our focus, if you look at where are we expanding our network, tier 2, tier 3 cities have been focused. Like if you like Hubli and Vizag and Kochi are some of the cities that we are building or expanding our network into, because we didn't have very fast delivery to those cities. So we are going to expand that. So even for Prime Day, for example, most of our new Prime customers that we signed up came from these smaller towns and cities. So we are seeing adoption of e-commerce and people coming online and shopping online across the country, especially from tier 2, tier 3 cities. In terms of GST changes, we are really excited about, like it came at the right time and hopefully it will spur consumption. But we are also very hopeful about how it's going to help the seller. The GST Council met. There's not just about the reduction in the rate, the slab rate, but also how much the government has listened to us around, let's make the life of selling online easier for all our sellers. So if you go into the details, there's so many of those changes that we are excited about, which will make the life of a small, medium business selling online much easier. And I'm really excited about the long-term impact of those changes.
Big developments as far as the GST rate rationalization is concerned, because clearly the implementation of the same is just around the corner and customers have halted their purchases, awaiting that GST particular relief. Now, Bizom believes that discretionaries may see further uptick once the GST takes effect. What will that look like? Well, Snehi joins in with what we're likely expecting as far as that is concerned? Let's listen it to.
So let's take a look at what the expectations are coming in on the back of this GST rate rationalization that has happened, and a lot of pushing of consumer demand is what we've seen, because naturally people who want to make bigger purchases of white goods or consumer durables, they are waiting until this 22nd August deadline for that to happen. So if you take a look at what this delay is, and we've got the view coming in from Bizome wherein they're saying that consumer delaying purchases near to the festivities because they're waiting for the GST relief. More consumption uptick is expected in discretionary purchases post the GST relief implementation. That is on the 22nd of this month. Consumer durables, home appliances, building materials, fashion should see an immediate uptick post the 22nd. That's the word coming in from them. For biscuits and snacks now, they say that there has been a GST relief of 7 to 13%, but they're not seeing any delay in purchases because, of course, these are consumer staples and are required on an everyday basis. They, however, see double-digit growth around 12% in August is what they're estimating that the growth for this category could have been. Shifting focus to home appliances and kitchenware. Now, this includes your larger white goods like ACs, TVs, refrigerators, where we have seen significant GST cuts happening. So there seems to be a pushback in these categories for now. For kitchen appliances, sales have slowed down 20% on a year-on-year basis compared to the last time this year, because people are waiting for the GST incentives to kick in. And for kitchen appliances and electronics, if you put both of them together, there's a cut of 25% on a year-on-year basis. Now, if you compare the month-on-month data across certain categories where we've seen spending in the previous month but a slowdown in this month, it's names like chocolates and confectionery, big drop in fact coming over here because the festive period came early this time. So all the buying got preponed to the July period. Oil, rice, sugar, spices. So the overall kitchen commodities, they have also seen a drop. Home care has seen a very big drop because people are waiting for that GST relief to kick in. And FMCG overall as well across India has seen a drop from 8.6% to 7.5% in terms of value growth. So that's a word coming in from Bizome, and that's the outlook on how the trends have been shaping up. And of course, we've been bringing you all of this live from the SBI Live studio.
With the GST rates coming into effect from the 22nd of September, FMCG companies have gone ahead and decided to take some measures to reduce prices and increase grammages for their products. We've gathered from exclusive sources that Nestle and ITC are going to be passing on these benefits to their customers in the form of price cuts. Speaking specifically about Nestle, what sources tell us is that they will be taking in some price cuts for the larger packs and increasing the grammages for the smaller packs. Now, Maggi, coffee, chocolate, milk, all of these products are going to get cheaper. Maggi, for example, for the larger pack of 280 grams, they are going to increase the grammage to 300 grams and also reduce the price for that SKU from 60 rupees to 58 rupees. As for the other variants of the noodles, there is going to be about a 6% price reduction there. Talking about coffee, Nescafe for all packs larger than 45 grams, they are going to be taking in some price reductions around 11% roughly, and the grammage increases will be taken in for the SKUs that are less than 45 grams. The ready-to-drink beverages will also see a 5 rupee price reduction on the Tetra packs, and the ultra-high temperature milk, all the Tetra pack milk, the 1 litre, will see a 3 rupee price reduction. Other than this, we are also gathering from sources at ITC that they are in the process of formulating a final price list given the huge number of SKUs. That is taking some time, but in the meanwhile, they have communicated to distributors and retailers about the discount schemes that they will be running for the existing stock. Now, this is being done to ensure that post 22nd September, there is parity in the prices of the older stock and the newer stock with new prices that will be sent to them.
These rejigs, there will be impact on the earnings of FMCG basket per se. What is your analysis? How much of this consumption boost will help these companies?
Yeah, see, first is, of course, if you see the government's intent is that companies should pass it on to customer fully. So my sense is initially FMCG companies will look to pass it to end customer at a portfolio level fully to the customer. So to that extent, the benefit for FMCG companies will be more in terms of the operating leverage. As I said, in food like biscuits and snacks, it will be a real consumption boost because in these categories, almost 50-60% of the consumption happens at 5 rupee, 10 rupee price point, and customer buys a pack. He doesn't buy X grams of biscuit or X grams of bhujia or namkeen. So in such cases, if the biscuit company is offering 12-13% extra grammage, or the bhujia company is offering 6-7% extra bhujia, that's a real consumption boost. So I would say that yes, there will be, I think, 2 to 5%, 2 to 6% kind of a EBITDA boost for many companies because of these reasons, because this is operating leverage kind of benefit. Here we are assuming that companies are fully passing it on to the end customer. But I would say that currently there is two kind of lack of clarity for consumer companies. One is what happens to the inverted duty structure, because some of the raw material is still at 18% kind of a GST rate. The services are at 18% GST rate. So if the end product is at 5% and the service and some of the RM is at 18%, full offset won't be possible. Yes, refund is a mechanism, but please note, for service, the refund is not available. So there is this bit of challenge. The second bit of challenge is some of the factories of the FMCG companies get mega project benefit, they get some fiscal benefit. Now again, those will continue. But issue is again at a SGST rate of 2.5% because the total rate, new rate of GST is 5%. So SGST is where they get a refund. At such a low GST rate, they will not be able to fully use it. So in such cases, state governments will have to extend the tenure. Now, there is no full clarity because these are discussions which are yet to happen.
Rabinder, thanks so much for joining us with all those details. But shifting focus, and as promised, let's put the spotlight on India's dairy sector then. And GST on several dairy products has either been reduced from 12% to 5% or it has been cut from 5% to 0%. What impact will this have on volumes? To understand exactly that, we are now joined by Manish Bandlish, Managing Director at Mother Dairy. Manish, afternoon, and thank you so much for taking your time out and joining us here on ET Now. GST has been cut by the government, and I believe you have also passed it on completely to the end consumer. This will come into effect on the 22nd of September. But before that, if you can tell us what kind of volume growth are you expecting on account of this GST cut on several dairy products?
Thank you, Ashisha, for having me on this program. I think this whole initiative by the Government of India to reduce GST on consumer products is a very, very welcome step, especially for the dairy sector. And this will give a fillip not only to the consumption, it will also give a fillip to the farmer income in the long run and the medium term. To give an example, our organized sector in India is only 35 to 40%. If you look at all the products combined, we expect basis this more affordability will happen in the dairy products, and over the next 6 months to a year, at least 10 to 15% extra growth is likely to come on most of the value-added products, especially. And this will give a much required fillip to the dairy sector in terms of growth for all the value-added products.
Understood. So 10 to 15% volume growth, that's the kind of growth that you're expecting on account of GST reduction. But Manish, if you can tell us, how will it help the entire ecosystem? I understand end consumers will consume more, especially in tier 2 and tier 3 cities on account of reduction in GST. But from scratch, from farmers, how will it help the entire ecosystem?
So I'll start with the consumer. So let's take an example of a paneer or a ghee or a butter. These are very popular categories. When the consumer is consuming a paneer, for example, is only not more than 4 to 5% organized today. When paneer becomes more affordable for the consumer, and if they start consuming more of that paneer because it is coming from well-known brand like Mother Dairy, who's focusing on quality, then I'll need more and more of milk to make that paneer and other associated categories like ghee, butter, or ice cream. If I need more milk, I have to go back to my farmers. I have more than 10 lakh farmers connected to our dairy ecosystem in our system, which means I will need more milk from the farmers, which means the farmer will get motivated to keep more cattle, which means their income will increase further. So this is the ecosystem I'm talking about. They'll get more. I will have to buy, or I will buy more milk from the farmers, and they'll get a good price for their production. So this whole dairy ecosystem will get a fillip, is how I see it.
Understood. So the entire dairy ecosystem is likely to get a fillip, and you're expecting strong double-digit volume growth on account of this. Now, that's a big figure. But I understand GST on several farm equipments has also been lowered. How do you expect this to aid farmer community at large and ultimately aid volume growth further?
See, like I said, once the farmer gets benefit, for example, a tractor, if the GST has been reduced, it will become more affordable for the farmer. They can easily invest in those farm equipments. They can easily invest into their technology, which they may not have been able to do today. So I think overall affordability at the farmer level, income increasing at the other end, will immediately help the farmers in the medium to long term being able to afford these products at a much larger scale.
So several GST reductions not only for agri products but for allied businesses and farm equipments in particular, that is also likely to aid the entire community and the rural market. Sir, thank you so much for taking your time out and joining us here on ET Now and helping us understand how the GST reduction on dairy products is likely to aid volume growth for the entire sector. Thanks so much for joining us today.
Thank you.
On that note, we need to slip into a very short break, but our coverage on commodities will continue on the other side.
All right. So essentially, Manjari, you're referring to, you being the company being hopeful of demand outlook. But in terms of numbers, what's the kind of growth that you're anticipating and looking at with respect to the festive season this year, given that GST benefits for hotel benefits have also been announced?
Sure. So industry, if you look at today, is early single digit, right? And especially after the geopolitical situations, etc., which is behind us, thankfully, we did see a slowdown. We are hoping and we are very confident that this year festive will come to us with a double-digit growth. And if industry is growing, and today we grow almost 3x of industry, and if industry starts to grow much faster, and if we keep the momentum and the scale that we have from industry today, that is the growth that we are wanting to achieve in the festive season. GST comes with a blessing. I feel that while air travel has not been directly impacted and hotel has been, in general, spending in India should go up, and that is the attempt of the government. And we feel that given travel has been one of the critical places where people like to spend, we feel that the resident effect on people stepping out and traveling will already be there. In terms of hotel, we are very, very confident that the GST reduction will help us reach the belly of the market, the mass India, and they will hopefully upgrade and want to book more hotels.
To answer all those questions, we have with us a stellar panel. Harsh Rungta, founder, Fee-Only Investment Advisors. We also have Madhvi Arora, lead economist, MK Global. And joining with us, Avnish Roy, Executive Director, Novama Institutional Equities. Madhvi, I want to come to you first. How much of the impact of this cut or rationalization will have on economy per se, because that is the pertinent question which all the stakeholders are asking?
So we have to see it from 2 points, right? One would be the balance sheet impact on the government of India and the balance sheet impact on the household. From the government's point of view, they are suggesting that they will be bearing a loss of nearly 500 billion rupees, which is around less than 0.2% of GDP. Now that is coming from the loss they would incur because of the cuts in GST to the tune of around 938 billion, and the net gain that they would make by implementing the sin tax, which would be close to around 450 billion. So net they are losing in their balance sheet roughly around 480 to 500 billion, which is less than 0.2% of GDP. On the other hand, from the household perspective point of view, whatever is the loss of the exchequer should be the gain to the other economic agents, whether it's household or the other private economic agents. But here, obviously, the impact is directly to the household. Apart from this, we also would be seeing dissolution of the compensation cess, which was roughly around 1,500 to 600 billion rupees. Again, close to around 0.4% of GDP. So if you include that and the net loss to the next checker, the balance sheet gain to the household could be as high as 0.6% of GDP. And if I look at the fiscal multipliers, generally the fiscal multiplier of indirect tax cut is close to around 1.2x. So the net gain to the economy, assuming that the government actually incurs this loss on its book and does not cut its fiscal loss by reducing its expenditure, Just from the balance sheet point of the government of India could be, around 0.3 to 0.4% of GDP over the medium term. But in the near term, I think the household could see almost 0.6% of GDP worth of benefit in their balance sheet over an annualized basis.
Harsh, I want to understand from you the pertinent question, where will these savings go? If somebody is saving 6 to 8% a month, do you think SIP number is going to be bigger, or you think even bank will get some of the share of the savings?
I think this is something that will need to be sort of, deciphered. There will be first order effects and then there would be second order effects, etc. The first order effect of something getting cheaper, classical economists suggest that, okay, the demand for that goes up. Now, some of these items, I mean, there is only so much toothpaste that you can sort of use. And, therefore, I don't know, I don't want to pick a specific category. So one is that for certain items, things like consumer durables, etc., where, the GST has come down dramatically, the demand may actually go up. People might actually spend more on them. They may actually move to that category from, say, an air cooler earlier to an air conditioner. It's very much possible. Secondly, whether they will save or spend also depends on what is, 3-4 big jargon, the marginal propensity to consume. When you have additional money in your hand, what will people do? So typically, the lower middle class and the middle class will tend to spend more with that money. The slightly upper middle class and richer people will tend to save more. So I think it's very difficult to know today what would happen. But if I was, to take a bet, I would say that the expenditure would go up because we are typically a very, very lower middle class and middle class economy. And I think that is good for the economy because what the government has given up in terms of the rate cuts on GST, probably it will make up on volumes, at least some part of it, it is hopefully will make up on volumes, and that's also good for the economy. So it's not necessary that this will go into savings or into investments.
Mr. Joshi, thank you so much for your time. Help us understand what could be the extent of the spur in demand that we could see from the GST rationalization.
Well, I think the GST primarily is a structural reform, and I think it improves compliance. It also has led to higher tax collections for the government and makes the business easy to do, I mean, so to say. But the time at which GST has been announced, and coupled with that, that they have reduced the rates for a number of categories, I think that has triggered hopes that it will be consumption positive. And we also believe that it will be consumption positive because we looked at the 30 categories of consumption from the household consumption expenditure survey. And we find that out of the 30 categories, which account for almost 88% of consumption expenditure of an average Indian household, 11 items, I think, which account for a third of consumption, have seen a reduction in rates. So what GST will do is, I think, two other things which are consumption positive are happening right now. One, I think, is the income tax rate cut, which was announced in the budget. On top of that, in general, inflation is low, particularly inflation on food items. And I think this is going to complement that further. And GST reductions will act on the inflation side, they'll act more on the core inflation. Because I think food items were anyway, most of them were under very low tax rates, so to say. So I think it will spur consumption. To what extent is a little hard to say right now, because the pass through is what people are waiting for. We have seen some quick pass through in durable segment, particularly the automobile, where the small category entry level vehicles are likely to see 8 to 9% reduction in prices. I think that's the CRISIL estimate. The mid-size will see around a 3.5% reduction in prices.
and the premium segment will see around 6.7%. So I think there is it's going to push consumption up. I would look at it as something which is complementing the other factors to support consumption, because investment scenario is not that strong. So I think consumption is a theme this year.
Well, it will certainly have a massive multiplier effect because, as we all know, India is largely a domestic consumption-driven economy. And if we can boost consumption, then that would more than offset the damage or whatever effect that will take place because of the tariffs. So I think it's a wonderful move. I think it's also wrong to believe that in the long term there will be loss to revenue. There'll actually be a gain in revenue because when consumption increases, the sheer amount of consumption will, and reduced GST rate on that will compensate for the reduction in the rate that is taking place. So all in all, very good for businesses, very good for the economy, and it will be a big boost to the middle income households.
Oh, well, yes, indeed. But along with that, Mr. Mistry, the other thing is that how the ease of doing business will pan out in the Indian economies. If you can help us understand that there were indeed several announcements for many sectors, but what, as per you, will be the biggest beneficiary at this point in time? Any sense there?
So we've seen so many measures which are more technical in nature, which have been talked about on your channel, on the process of easing the amount that is payable and making it easier for the SME and the businessman. So leaving aside that, the sheer fact that a measure like this will boost consumption because prices will come down will itself be a big boost to the economy.
Let's discuss with Ajay Bagga how big an opportunity this is turning out to be. Ajay, hi, afternoon. Thanks for joining in, and apologies to keep you waiting. We were just getting some perspective on how, the markets are perceiving the impact of GST 2.0 on various sectors. But Ajay, as an investor, I guess the question is going to be, because up until COVID to now, you had only played the premiumization trend. Do you now look at more top-down approaches when it comes to consumption?
Well, I would not say that things will change very much. What is changing is it's a very structural stimulus that has gone in, and this stimulus will go in year after year now, unless there is a rollback into higher rates, which we don't anticipate. So the immediate reaction of the markets might have been muted. But what I'm expecting is that all the interest rate moves that have come in, the monetary policy liquidity being injected, overall the income tax slabs putting on the margin some more money into people's hands. We have seen rural demand growing stronger than the urban demand. So the catch-up story the markets are waiting for is the urban demand picking up. So does this lead to urban demand picking up? We'll know in the next 2 months. But I think a very good structural stimulus has been injected by the government. What trends will it change? Will the premiumization move to a more broader-based rally? That we have to see. But definitely, there'll be more money in people's pockets after their usual spends. And that normally goes back into consumption. So the consumption multiplier works when you cut consumption taxes like this. So the government has got it right. There are some issues to be ironed out, like the input tax credit, then the anti-profiteering to ensure that companies are passing on these advantages to the customers. I think those two remain the issues which has made the markets muted. But if you take all this together, I think we are setting up for a good market recovery. When that comes, what is the catalyst? We'll have to wait. Maybe this is the catalyst that we will know after about 2 months when we actually see how the festive demand passes through.
look ahead into the future, figure out what the markets would do and what investors should be doing. We've got Harsha Upadhyay joining in on the show right now. Harsha, hi, morning. Good to have you on the show. Harsha, a lot of news flow now seems to be getting addressed pretty much along the expected lines from the market, be it domestic or for that matter now at the Fed as well. Of course, the big overhang continues on the US tariffs, but hopefully there should be a resolution to that as well. You think all baked into the markets, or do you think the markets would await to see what the consumption fillip is after the GST comes into effect come 22nd, the slab changes that is, and then perhaps directionally move higher from here?
Good morning, Ayesha. If you look at GST related upside or sentiment change, I think more or less that has played out in the very near term, in our opinion. Most market participants understand that probably Q2 numbers are not going to be as expected earlier. There will be some deferment of purchases into Q3. But when you look at Q2 and Q3 together, I think there should not be any disappointment. And probably, given the fact that GST reforms are structural in nature, this upside should continue over the next few quarters, few years as well. However, what is not priced in by the markets yet is probably any resolution to India-US trade relationship. Anything positive coming out of that in the near term could increase foreign participation in India. If you look at last couple of months, we have seen some flows from developed markets flowing into emerging markets for many of the emerging market economies. There has been inflows in the past couple of months. However, India has been an exception. And what has happened in this phase is the usual premium that India used to trade at vis-a-vis emerging markets has come off quite a bit. On a 5-year average, India has an average premium of about 70% over emerging markets. And now that premium has shrunk to close to about 40 or 45%. While we are still a little bit expensive compared to emerging markets, but I think given the fact that over the last year, India has underperformed and off late as well, because of the trade issues, we have not seen large flows coming from FIIs. That could change if there is any early resolution to US-India trade negotiations.
Making of the market. Ajay, hi, morning. Lots of consolidation, and I guess the market was just waiting to show us what it's been showing on the ticker for the last 2 days. It's already closing in on 25,500. Seems like a new high before Diwali, Ajay.
Good morning. Good morning. Yeah, I think so. I think, this any tax cut of the kind of a GST has done, it's a great signaling because money moves from the government to the people, which is a far more efficient way to run the economy. So I think it's a great positive. One has to see how much of the elasticity of demand which comes through what's happened in the last 1 month. We have postponed a lot of purchases. So cumulative impact will come through over slowly. But by and large, the optimism is that the mood in the government policy is towards more liberalization of taxes. And I think that's the important feature for the market. And number two is the realization that, consumer demand can't be ignored up to a point. And then you got to step in and stop that needless road expansion which was taking place and direct some of the money towards smart city, etc. All in all, I think the policy framework has changed. And as always, equity guys, we need to change with the policy framework. Market is strong, positive, flows are good, valuations are now stratospheric. So now you are in the true casino territory of equity investing.
Okay. So what are the short-term trades that the casino is throwing up, and what's looking attractive right now from a market standpoint?
See, capital market looks to be stronger. It got a big leg up in the last 1 year. It corrected quite rapidly and has come back again. So I think capital market participants will do well. I think there has been a lull in the infrastructure companies. They should do well now, given the fact the consolidation, the correction put together. Ps are still high, but I think they will get a lot of traction in the next 6 months because it's been neglected for a long time. And, neglected sectors tend to bounce back faster. IT, perhaps confidence is misplaced in my view. That won't happen very much in the sense of, in terms of their own performance at this point of time. But domestically, auto, you've already seen it's been a run up. Now it's going to go on to auto ancillaries. So all in all, I think any other sector which impacted by Aisha by the GST cut, particularly the auto, I think it's going to be a great beneficiary. We have a great auto industry. We are global leaders in that. So I think that's one industry as investors you can pick, and that I would say outside the casino. Casino is right now the small caps and the retail stocks and all running at 90, 100, 120 Ps. I think anything beyond 50 P or 60 P, I would put it in the category to say you must have a very good reason, apart from newcom stocks, leave aside, you must have a very good reason why to be there. And there are a lot of stocks at 70, 80, 90 Ps. I think that's where the real roulette game is going on. There's going to be black or white. And I think that's where the problem will come, is that when you buy a stock at 90, 70, 80 P, you really are trading very, very treacherously.
Right, Ajay. Hi, morning. This is Nehi also
Good
joining
morning.
in. Good morning. Now, the last time we interacted, Ajay, it was just days before the GST meeting. And now that the outcome has come out, we have absolute clarity on what reduces and what looks better. I remember you had said that you will not be adding anything to consumption on the back of this GST cut. Well, that may have been on staples. What's your take on the overall consumption? Could be discretionary, white goods, retail. Are you staying away from those two?
See, it's important to understand that GST cut lowers the price for everybody. Okay, it doesn't lower the competitive intensity in the market, which is quite high in Indian context. If you look at durable market, we are in a very high competitive zone, and you as any portfolio manager does, or anyone does, you need to allocate your capital to where you feel most comfortable. In any sector where the competition is 10, 12, 14, 16, 20 companies competing for the same share. Now, GST applies to everybody. So everybody cuts the prices or supposed to cut the prices. So it doesn't relatively affect the competitive ability of one company to score over the others. Demand may go up. Let's see how much it goes up. I'm quite, it's not going to be like, it's going to jump up 30, 40%. People were buying, and this affluent segment was buying on loans or whatever. So therefore, the segments where the competitive intensity is so high, we tend to stay away from it. We like sectors where you have got 2, 3 players with a clear moat to make returns over time. And therefore, one of the two of the competitive players may do well in 1 year. Somebody may take the lead in the second year. So in the long-term portfolio, you tend to have a very, very kind of a risky profile of some of the segment, including consumer durables. That's why we keep away. And beauty is, India has given you so many new companies to invest in, new industries, new e-com companies, new segments, newer fresh blood coming in. So you don't really have to go back to the old bread and butter. If you look at the US market, where is the market cap?
Welcome back. You're still watching Markets at Noon, and now we have with us none other than Radhika Gupta, MD and CEO, Edelweiss Mutual Fund. Radhika, good afternoon. Mansi this side. Thank you for giving your time to ET Now. And I'll start with your tweet. When the world pushes us into the corner, we push ourselves to fight back harder. Yes, it is, and it's a bonanza move which India has shown. And at present, if we see all positives. Now, how do you see this GST reform changing overall sentiment of the market? And do you even think there'll be a sectoral re-rating or churning from here on?
So, hi, Mansi. Thanks to ET Now. Look, I think, as I said in the tweet, this is a move that is the need of the hour, and it comes at, the right time. Now, we are in an environment where we have pressure from tariffs, although I still hope that situation will sort itself out. But we do have pressure from an unfair tariff regime. And the real challenge we have is how can we boost consumption and perhaps do things to offset some of the pressure from the tariffs. And I think if we look at Q1 earnings, we have seen some sluggishness in consumption. Now, earlier this year, I think the government took a big step in terms of tax relief to the average consumer. This is one more step. I particularly think if you look at FMCG as a sector, if you look at consumer durables as a sector, and of course the biggie here, which is auto, I think this does act as a demand boost because a lot of goods get meaningfully cheaper in this segment. So I think, and inflation also comes down. So it's a de-inflationary move in that sense. So very, very much the need of the hour, and perhaps the way that, we have to combat, the global volatility that we're surrounded by. So while, I'm sure our trade teams are negotiating and working on that, this is really the best finance ministry could do.
All right, definitely. Hi, Ankur, this side. Radhika, I want to understand from you the part you mentioned about the churning. Now, this will allow the market participants to pick and choose the sectors and look for the growth opportunity. One is, of course, the consumption part. Do you think with the global uncertainties still being there and tariff resolution not in sight, there will be interest in the sectors other than consumption as well?
So, I mean, it's very sector specific. Look, the reality is with the global uncertainty, portfolios will have to be biased, in our view, to businesses that are more domestic in nature. Now, consumption or non-consumption, you can debate, but they have to be more domestic in nature. Businesses that are more export oriented, so you look at something like chemicals, or you look at something like jewelry, will they get hurt from tariffs? I think that is a reality that we are combating. So in our portfolios, I think the key focus is businesses that are domestic. So it could be domestic capital markets, it could be domestic consumption, it could be domestically oriented healthcare and hospitals, but it has to be domestic oriented. So I think the clear rotation is happening in portfolios towards businesses that tap the Indian consumption story. And that's really what you need to give a boost to. I mean, that's the engine that's going to fire today.
Station forward, we've got Saurabh Mukherjee from Marcellus Investment Managers joining in on the show right now. Saurabh, hi, morning. The big GST reset, I guess when it comes to the consumption fillip that the economy needed, one couldn't have asked for more. But do you think that's going to translate into equity markets seeing that bump up as well?
I think the big thing to cheer here is, in a way, some consistent with the budget in February earlier this year, Aisha. The government is now turning towards consumption, right? I think in the February budget itself, the middle class tax cut was a step in the right direction. I think this is yet another big step in the right direction. This whole emphasis on government capex, I think, will gradually fade away. And the entire focus, the government's focus will be on reviving consumption because that's 60% of GDP. So positive move. The two areas of caution I would flag is the downside effect, the detrimental effect of Trump's tariffs will only show up over the next 3-4 months. I was in the Tirupur-Coimbatore area yesterday, and people there are in a state of shock. The textile sector is in a state of shock. I think we will see major downside impacts there if the 50% tariffs continue. Similarly, in the gems and jewelry sector in cities like Surat, Agra, Lucknow, Ludhiana have big footwear export and sports goods export sectors. So it's worth keeping in mind in this morning's euphoria that there'll be massive downside impacts on the economy. It's easy for us to say on TV that it's a 1% of GDP hit to the economy when Trump hammers us with 50% tariffs, but the pain will come in the coming quarters. And the second area of caution as we celebrate the GST cuts is the job creation picture. The white-collar job creation picture remains grim. I think we're heading for savage job cuts in the IT services sector. That too will drag down consumption. So on the whole, boost from GDP, boost to a consumption of 1 lakh crores, I would say roughly from the GST cuts, but comfortably counteracted by Trump's tariff hit on India. And therefore, overall, I'm not so sure there's a big GDP growth boost, whilst the economy tilts away from government capex towards consumption. People like Marcellus, folks at Marcellus who invest in consumption stocks, we are happy about it. But overall, at the economy level, I think the good and the bad is counterbalancing each other.
Settling in quiet right now, let's take the conversation forward. We've got Gautam Dugar as well joining in on the show right now. Gautam, hi, morning. Great to have you on ET Now. Gautam, so much has happened, right, with regards to what the government has done in terms of pushing demand and growth higher. I mean, be it the rate cuts from the RBI, be it all the taxation cuts which are still trickling into the economy. And then, of course, this big GST bazooka. But Gautam, that's not really reflecting on the markets. Why is that?
Hi, Aisha. Good morning. Thanks for having me. Yes, I mean, this is something which has perplexed everyone over the last 24 hours. But look, Aisha, there are 2-3 things at play here. First and foremost, this relentless selling from foreign institutional investors. I mean, just to put numbers in perspective, in the last 20 months, and calendar year 24 plus first 8 months of calendar 25, foreigners have sold $15 billion. Against that, domestics have bought $123 billion, $63 billion last year, and $60 billion roughly in the first 8 months, right? So if you focus on just calendar 25, again $60 billion, we have seen $15 billion of selling from foreigners, and roughly then you have seen a lot of activity on the primary market, corporate blocks, promoter blocks, PE blocks. So that is a pressure of supply which has kept the market a bit suppressed. Second, the valuations of Nifty at about 21, 22 times, while not exorbitantly expensive, and even for that matter, mid-cap, small-cap indices at 25 and 27 times, they are giving some bit of discomfort. Typically when your earnings grow at 15 to 20%, 22, 25 P do not look expensive. But when earnings grow at 5 to 8%, the same 2022 P look slightly expensive, right? So last entire year FY25, our corporate earnings growth was literally zero. You've seen 1% Nifty EPS growth and 4% absolute profit growth in the broader markets of roughly 325 coverage universe companies that we have. Now, this year we have an expectation of about 8 to 10% earnings growth. First quarter was pretty good. We've seen earnings upgrade in mid caps while marginal downgrades in large cap and small caps. This is giving us a hope that we will end the year at about 10 to 12% earnings growth. And as the cumulative effect of all the actions that you just enumerated, they take hold, the rate cuts, income tax cuts, the GST cuts, infusion of liquidity, you have a good festive season around the corner. We hope that sentiments will lift in the second half of the fiscal year, that is starting 1st of October. And then market may at least trail the earnings growth that we're expecting this year. Till then, it's going to be a very bottoms up, stock by stock, sector by sector market. So you saw very good rally in auto index in the last 15 days. In fact, so much so that auto is now the best performing index of the year. It was banking till August. Now it is auto after the 6-7% index rally. And typically what happens when such a big news is anticipated, usually we have seen that market take some profit off, buy on rumor, sell on news. That sort of equation played out yesterday. But keeping the day-to-day or week-to-week market fluctuations aside, this is a very big step that the government has taken, probably the best and the biggest reform that the government would hope to undertake in its third term. Let's see, they have a lot more on the anvil. Mr. Piyush Goyal at our conference this week, at our 21st annual conference, he spoke and he mentioned about a series of initiatives that the government has planned. Prime Minister himself has hinted about arsenal of reforms that they're going to unleash. So we'll keep our hopes intact.